Are you an aspiring homeowner who has heard about all the costs that come along with buying a home? Are you worried that you can't afford a down payment, closing costs, etc.? Did you know that you may be eligible to receive grants and assistance with these costs? Stick around because in this video, I'm going to discuss several programs in Texas that can help make your home ownership dreams a reality. If we haven't met, I'm Lexi Esparza, the realtor that educates. I am a Texas affordable housing specialist, and I love helping first-time homebuyers like yourself find their desired home across South Texas. So what is affordable housing? This is when a family or individual pays no more than 30% of their total household income on a mortgage, insurance, taxes, and utilities if they own the home. While there are several organizations that can assist with affordable housing, I will be focusing on the Texas State Affordable Housing Corporation, also known as TSHAC, in this video. And I do want to give a quick disclaimer. I am making this video as a TSHAC participating realtor and Texas Affordable Housing Specialist. I am not an employee of TSHAC. All right, let's continue. TSHAC is a nonprofit organization whose mission is to serve the housing needs of low to moderate income Texans. They have two homebuyer programs, Home for Texas Heroes Home Loan Program and Home Sweet Texas Home Loan Program. Through these programs, they help almost 2,000 families buy a home each year. Both programs require the individual or family to meet certain income limits for the county where they are purchasing the home. The main difference between the two programs is the eligible professions. The Home Sweet Texas Home Loan Program is open to anyone, regardless of profession. On the other hand, the Home for Texas Heroes Home Loan Program is open to educators such as full-time public school classroom teachers, teacher aides, school librarians, school counselors, and or school nurses. It is also open to peace, police, and corrections officers and county jailers. Firefighters and EMS personnel may qualify as well. And lastly, the Home for Texas Heroes program is also open to veterans and active duty military. These professions were selected by the Texas legislature as careers for which the state wanted to make home buying programs available. Now let's get into the types of assistance TSHAC offers through these programs. Both the Home Sweet Texas and Homes for Texas Heroes home loan programs are available statewide with no limitation on location. The first type of assistance is a low interest rate mortgage loan with down payment assistance attached to the loan. The loan is a 30-year fixed rate mortgage and may be in FHA, VA, USDA, or conventional mortgage loan. The assistance may be used for your down payment and to help cover your closing costs. The second type of assistance is a special mortgage interest income tax credit. This income tax credit will help reduce the amount of income taxes you owe the IRS every year, as long as you live in the home, which will in turn increase your take-home pay that may be used to help pay your mortgage payment. This tax credit may be combined with the down payment assistance too. So, not only does TSHAC help you get into the home with down payment assistance, but they also provide an income tax credit which may help you pay your monthly payments. Let me dive a little deeper into my explanation of how the loans with down payment assistance work. If you would like to participate in this program, you will have 4 different percentage levels of down payment assistance available to you: 2%, 3%, 4%, and 5%. It will be up to you to decide which assistance you need. It is important to note, though, that the lower the amount of assistance you choose, the lower the interest rate will be on the 30-year fixed rate mortgage. Interest rates change daily, so I can definitely help you get in touch with a TSHAC participating mortgage lender to keep you up to date on those rates. They can also help you decide which percentage of assistance and type of loan, whether it be FHA, VA, USDA, or conventional, would be best for you. Another thing that is awesome about this program is that you do have some flexibility when using the funds. You can put the money toward your down payment, closing costs, to reduce your loan balance, or any combination of the three. Also, you do not have to be a first-time homebuyer to use the TSHAC DPA program. However, it must be used to purchase your primary residence. In other words, you cannot use this to purchase an investment property that you don't plan on living in. The down payment assistance comes in two forms. Option 1 is a grant you can receive that never needs to be repaid. There are no strings attached, and you do not have to purchase in any certain areas of Texas, nor do you need to stay in that property for any period of time. It is a true gift. Option 2 is a 3-year deferred forgivable second lien that allows you to choose any of the loan types and any assistance level. It will provide lower interest rates on the first lien than the grant option, and it will actually become a grant after 3 years. Another option through the down payment assistance program is a conventional loan that TSHAC offers through Fannie Mae called Housing Finance Agency Preferred, and another offered as a Freddie Mac product that is called Housing Finance Agency Advantage. These conventional loans are only available to housing finance agencies like TSHAC. It is interesting to note the special perks these loans provide compared to the FHA and traditional conventional loan. The monthly mortgage insurance rates are much lower, and there is no upfront mortgage insurance premium, unlike FHA loans. This will save you on upfront closing costs or an increased loan amount and no LLPAs, unlike traditional conventional mortgages. Best of all, you are able to cancel your mortgage insurance, which can save you thousands of dollars compared to the life of loan mortgage insurance premium with an FHA loan. Now, yes, the interest rate on this loan product will be a bit higher than that of an FHA loan. However, please keep in mind that your monthly payment may not actually be much different given the lower monthly mortgage insurance rates. The comparable monthly payments make this a competitive alternative to FHA. To help you compare all the different assistance and loan options you have with TSHAC, they created a loan comparison calculator. You can compare up to 3 loans at once, and it will demonstrate the minimum down payment required, TSHAC assistance amount, additional down payment needed, monthly mortgage insurance premium, and combined monthly payment. Looking at all of these things will help you make an educated decision on what is best for you, and I will link this calculator for your convenience. Let's go ahead and switch gears and talk about the second form of assistance TSHAC offers, which is a mortgage credit certificate, also known as an MCC. This is my personal favorite, and I like to call it the gift that keeps on giving. This special mortgage interest tax credit is only for first-time homebuyers, meaning that they have not had ownership in a primary residence for the last 3 years. An MCC gives a homeowner the ability to claim an income tax credit equal to 20% of the mortgage interest paid annually. This credit may be used every year for the life of the loan as long as you occupy the home and it is your primary residence. One of the best features of an MCC is that it can help you qualify by reducing the debt to income ratio on the mortgage loan, which gives you more buying power. Remember that this tax credit may be combined with TSHAC's down payment assistance at the same time. Plus, it's free for Texas heroes who are also using TSHAC's down payment assistance. Now, I know that was a lot of information, so let me provide an example of what an MCC can look like. If you see here, the loan amount is $200,000 with an interest rate of 5.75%. The interest you would spend in the first full year would be $11,500. Now, 20% of that is equal to $2,300. Therefore, you would be able to take a tax credit equal to $2,300 that year. Now, you may be thinking, everyone benefits from mortgage interest on their income taxes, so what's the point of an MCC? Now, this is true, but you must remember that an MCC is a tax credit, so it provides a dollar-for-dollar reduction on an income tax liability or taxes owed, while tax deductions allow one to lower the amount of the taxable income by the amount of the mortgage interest. Here's an example. If you pay $5,000 in mortgage interest and your income is $50,000, you can reduce the amount of taxable income by the amount of interest you paid. This would reduce your taxable income to $45,000. This is the amount of income you will pay taxes on. A $2,000 deduction, for example, might reduce your tax bill by only $300 to $400, while a $2,000 tax credit cuts your tax bill by all $2,000. An MCC allows you to take advantage of both forms of savings. Using the previous example, you can take the remaining mortgage interest in the amount of $9,200 because you would subtract the $2,300 credit from the $11,500 you paid interest, plus any property taxes, etc., as a deduction. An MCC is still better, and let me show you what a dollar-for-dollar reduction for your tax liability can do for you. Now, you may be thinking, Lexi, I'm already getting a tax return. How would I benefit from this? Let's say this bucket represents our home buyer Sally's income tax liability, which happens to be $10,000 per year. Like most people, Sally's employer has a portion of her paycheck set aside through her payroll income tax withholding so that hopefully by the end of the year, Sally will be able to cover her entire income tax liability. Fortunately for Sally, she had more than enough taken in payroll deduction to cover her $10,000 income tax liability. Therefore, once her bucket had $10,000, her remaining payroll deduction started overfilling the bucket, which results in a tax refund. In this example, Sally paid too much and gets her own money back as a tax refund. Now, let's see what would happen if Sally had a mortgage credit certificate. Sally, again, has an income tax liability of $10,000 a year, but this time she bought a new house as a first-time homebuyer and took advantage of the benefits of an MCC. Because Sally had an MCC, the $2,300 MCC went into the bucket before any of her payroll deduction. Now, her remaining tax liability is only $7,700. It directly reduced what she owed dollar for dollar. Sally has more than covered her remaining tax liability of $7,700 because she kept her payroll deductions the same, which means her tax refund has also increased by $2,300. Another option for Sally would be to update her W-4 form with her employer to reduce the amount of her payroll deductions by $191.67 a month. And this is just the $2,300 credit divided by the 12 months in a year. If Sally adjusts her W-4, then she will receive the credit every month by increasing her take-home pay in the amount of $191.67. Of course, it is important that you check with a CPA to confirm that an MCC will benefit you. And you will also need to claim this credit every year on your tax return. However, it will likely benefit you if you have a tax liability, which simply means that you owe taxes on your annual income. The credit cannot be greater than your income tax liability, but any unused tax credit can be carried forward for up to 3 years. Most people pay federal income taxes on their income, whether it is deducted from each paycheck or paid at tax time on their tax return. This program is a great benefit for first-time buyers. Essentially, it's as if you're getting a lower interest rate on the mortgage because you are getting some of the interest money back in the form of this tax credit. Some important takeaways I discussed today are that there is no need to be a first-time homebuyer to use TSHAC's DPA. DPA is a true grant, no need to be repaid ever. Because this is a grant with no lien, there is no requirement to stay in the home any number of years. A home buyer can purchase anywhere in the state of Texas because TSHAC is available statewide, and there is no minimum time on the job required for Texas Heroes to get the free MCC, and turnaround times are fast. It takes 24 to 48 hours to review a file, so it may not take any longer than a traditional loan. So, how do you determine if you can use one of these programs? First, visit www.readytobuyatexashome.com and click on the Home Buyers and Renters tab at the top of the page. You will see the Take the Eligibility Quiz. This will walk you through the eligibility criteria with 4 simple questions. Once you receive your results, and if eligible, you will need to contact a participating T-Shack lender. And I am more than happy to get you in contact with lenders who I have worked with that do an excellent job at assisting clients, or you may of course choose your own from the site. Once you are in contact with a lender, they will take you through the steps to apply, see what you are eligible for through your application, issue a pre-approval letter, and then we can get to the exciting part of searching for your home. The process of buying a home can be scary, and I totally understand. As a first-time homebuyer myself, I can empathize with you. The good thing for you, though, is that you are already taking steps to educate yourself just by watching this video. If you enjoyed this video or found it helpful, you may want to check out my previous videos where I detailed the home buying process and 10 things you should know as a first-time homebuyer. If you would like to know more about how T-Shack programs can benefit you, click the link down below to schedule a buyer consultation with me. If you're not quite ready yet, no worries. I have a link to my free home buyer's guide that you can download as a resource for you to have until you are. Thanks for tuning in, and I hope to see you next time.